This is the beginning of part 2 of our module on own equity transactions, which analyzes a number of strategies used by corporates and financial institutions involving their own common shares, often referred to as own equity transactions, whether for fundraising, hedging, or other purposes, and the complex accounting, regulatory, and legal issues relating to these strategies. We remind you that this part 2 contains 4 chapters, with chapter 3 discussing put writing programs, often implemented in connection with share buybacks or on a standalone basis, including once again complex accounting issues that relate to these. Chapter 4 describing employee stock option programs, the arguments for and against them, their accounting treatment, and the ways in which companies hedge the dilution risk that these present. Chapter 5, examining the use of total return swaps on an issuer's own equity to generate funding in a cost-efficient and leverage-friendly manner. And finally, Chapter 6, containing the final quiz. This chapter 3 discusses put writing programs often implemented in connection with share buybacks or on a standalone basis, including once again the complex accounting that relates to these. Selling puts on any asset is a well-established bullish strategy. The put seller happily collects the premium while expecting the underlying to rise and therefore the put to expire worthless. Put writing is also used, however, in connection with so-called accumulation strategies. An investor has concluded that an asset is attractive at current prices for long-term inclusion in her portfolio, but that it will take time to accumulate the aggregate amount desired. So the investor accompanies her gradual purchase of this asset from the secondary market with the sale of puts struck at or slightly out of the money, reducing her purchase price by the premium received and comfortable in the knowledge that if the put is exercised, the asset she receives is the one she wishes to hold for the long term. Not infrequently, the asset in question is none other than the investor's own common stock, illustrating how put writing is often tagged on to a pre-approved share buyback. To call this situation a win-win, as some bankers do, ignores an essential point, however. The sale of the puts takes away the writer's ability to change her mind in the future if she later concludes that the asset is no longer attractive and that her accumulation strategy should be abandoned or reduced. The writer must be comfortable that the premium she receives is large enough to offset this risk. Rarely has this risk been more prominently manifested than during the financial crisis of 2008-2009, when bank stocks in particular collapsed to levels far below the strikes of many put-writing programs, and issuers found themselves purchasing their devalued shares at prices well in excess of their market value. We note also the liquidity problems that these programs caused, at least those that were structured with physical settlement or with net cash settlement. The risk of a liquidity squeeze partly explains why many of these programs are executed with net share settlement, eliminating the risk of future liquidity pressures, but substituting for it the risk of significant dilution in cases of a steep decline in the stock price. The mechanics of own stock put writing are relatively straightforward. The contract identifies the tenor, the number of underlying shares, the strike, the premium, the mode of settlement, and whether the put is European or American style, plus a few minor items such as how to handle significant unexpected distributions of dividend. For purposes of our upcoming illustrations, we assume a 1-year tenor, 1 million underlying shares, a strike of 100, European style exercise, and an upfront premium of $6 per share, calculated via a Black-Scholes model for European options and an assumed volatility of 20%. All other inputs, such as the zero dividend and the constant 4% risk-free rate, have been retained. For a number of reasons, the use of an unmodified Black-Scholes model results in material inaccuracies, the most important of which stems from the wrong way counterparty risk exposure we identified also in the case of the forward purchase, perhaps best understood by observing that Black-Scholes gives full probability adjusted weight to scenarios in which the put goes deep in the money without reflecting the increasing probability that the issuer will be unable to honor the put given the collapsing stock price. Note also that several of the observations we made about the forward purchase apply just as much in the present case, including the allocation of the dividend rate risk and the reality that pricing would be adjusted to include a profit margin for the dealer. Finally, to make the example more interesting, we assume this time that the stock price on December 31, 2010 at the year end drops to 98 and stays there until the option expires 1 month later. The fair value of the option at year end under the Black-Scholes model is approximately $3.20 per share, subject to the caveats we mentioned. We are ready now to illustrate the accounting for the transaction under each of the 3 settlement alternatives. Under physical settlement, IAS 32 classifies the put as an equity contract that gives rise to a liability for the purchase price. The size of the liability recognized initially on the balance sheet is the present value of the purchase price under the put, which, discounted at 4% for 1 year, is approximately $96.15 million. The difference between the $6 million in cash received as a premium, which is also recognized on the balance sheet at inception, and the liability of $96.15 million is dealt with by debiting equity for $90.15 million, effectively treating the transaction as giving rise to an immediate reduction in the issuer's capital, despite the fact that exercise at expiration is far from certain. There are no entries in the income statement at inception. Next, on December 31, 2010, i.e. at the year end, with the liability having accrued interest at 4% for 11 months, the income statement records an interest expense for $96.15 million times this 4%, adjusted for 11 months, which equals $3.53 million, where again, we are assuming as before that the issuer is using the effective interest method. While on the balance sheet, we credit, i.e. increase the liability by an equal amount, and therefore to $99.68 million, and we reduce retained earnings by $3.53 million as well. Finally, on the expiration date, i.e. February 1, 2011, an additional interest expense of $0.32 million is recorded in the income statement. On the balance sheet, retained earnings diminish by the same amount, while the liability increases by an equal amount and becomes $100 million as expected. And a split second later, when the put is exercised, the liability disappears and cash is credited, i.e. reduced, by $100 million as well. The accounting treatment under net cash settlement and net share settlement runs parallel to that of the forward purchase. In both cases, IAS 32 classifies the put contract as a financial liability, and IAS 39 again requires the contract to be accounted for at fair value on the balance sheet and for changes in fair value between reporting dates to be recorded in the income statement as profits or losses. Therefore, under net cash settlement on day one, cash is debited by $6 million and a put option liability for $6 million is recognized at the same time. No entry occurs in the income statement, just as before. Then, on December 31, 2010, i.e. the year end, with the put option value standing at $3.2 million, as we said earlier, the income statement records a gain from the option equal to $2.8 million, while on the balance sheet, retained earnings are increased by this amount, and the put option liability is reduced by an equal amount becoming $3.2 million. Finally, on the expiration date, i.e. February 1, 2011, the put value shrinks further to $2 million, so the income statement records another gain from the option of $1.2 million, which is reflected on the balance sheet as an increase in retained earnings. The put option liability diminishes once again on the balance sheet from $3.2 million to $2 million. And 1 second later, this liability is eliminated while cash is credited, i.e. reduced, by $2 million. The exact amount of the net settlement payment, given the final price of 98 and the strike of 100. Under net share settlement, the entries are identical, except for the very final entry involving settlement of the put's $2 million intrinsic value by the issuer, which of course is implemented this time by delivery to the dealer of shares whose value is $2 million. Therefore, the issuer credits, i.e. increases common equity by $2 million rather than cash as under net cash settlement. This completes our discussion of put writing programs and brings us to the end of this chapter 3.